Hey, Diana, did you know that managing your cash flow is easy?
Mark, that's the dumbest thing you've ever said.
Ladies and gentlemen, jurists and just curious, welcome to the Successful Barrister podcast. Here you'll learn about marketing, management, and life skills for lawyers that probably won't get you disbarred. Hosted by Marc Whitehead, a seasoned lawyer who remembers when fax machines were cutting edge, and Diana Berry, attorney, COO, and the brains behind the scenes. Together, they are the legal world's most dynamic duo since statutes met regulations. So if you're looking to build a practice, not a prison, you're in the right place. Welcome to the Successful Barrister, where legal legends are made.
And welcome to the Successful Barrister podcast, the podcast for lawyers about marketing management and life skills that probably won't get you disbarred. I'm your host, Marc Whitehead, alongside my co-host, Diana Berry, my right hand, my CO. Hey, Diana, what's going on?
Oh, not much, Mark. I saw this thing on Instagram earlier, and you've been hearing it for about 2 months now, but Maycember. You've heard me say Maycember.
I heard you said that all week long, and I still don't know what that means.
Probably Maycember. So for parents and just a lot of people, May can feel like December, where it's just parties and theme weeks and award ceremonies and all these things that the schools sometimes just are like, okay, we're doing this tomorrow. Make sure you have, a new outfit, and we're free dressing and all the things. And Maycember is what I saw on Instagram, and Maycember's almost over. I'm very excited.
Well, and I feel you, so I will chip in there that my youngest is graduating from high school here in May.
Congratulations.
In a couple of, about a week, she graduates. So yes, Tina and I are thrilled to be kicking the last one out, like boom, out you go. Mom and Dad are going to travel, so we've already got
sad eyes that this is your last
Hell
one?
no, this is the fourth one. We are so ready to be done.
Wow. Well,
Yes.
that's exciting.
I'm thinking about giving away the damn dog so we can be totally free.
Congratulations, Mark. That's huge.
Yes, we have the trip to Europe already planned. We have trips to Vegas planned. All of the things that we planned on doing when we became empty nesters, and boom, we're doing them.
Are these on the calendar?
They'll get there.
Okay, well, that's another conversation. What are we talking about today, Mark?
Well, we are talking about cash flow, particularly the cash flow mindset and how cash flow affects the operations of a law firm. And this is one of those tricky things that law firms, particularly, when they're still in their infancy or maybe they're in their midlife crisis, frequently have trouble with. You and I have been battling, cash flow tracking, recording, prediction for the last 2 years. And I think we finally have turned the corner. We finally turned the corner.
Knock on wood there.
Knock on wood. We've had the help of a fractional CFO and a financial advisor. And I think we finally have figured out a lot of where the gaps were.
Yes.
And some of our misunderstandings. And quite frankly, our cash flow has been better lately. Our understanding and our predictability of our cash flow has been better lately. And it certainly makes you sleep better at night when you know that you're not worried about, well, how are we going to make payroll here?
Or are we? Like,
am I going
to have a cash flow problem this time?
Basically, what that means in our firm when we have a cash flow problem, Mark has to go into his personal funds and write a check.
As other owners do.
As other owners do all the time. If you've owned a business, at some point, more than likely, you had to dip into your personal funds to cover payroll or cover expenses or cover bills. And that's just never a pleasant thing to do.
Well, and I think probably for owners, where I found it kind of hit for you was it's payroll week, and you didn't know that it was going to happen, that we were going to have a cash flow problem. And so then all of a sudden you have to move money into different bank accounts. But then also that would happen sporadically. So it was almost like the not knowing, and you were just almost kind of makes you a little edgy. It's like, okay, well, are we going to make cash flow or payroll this week?
Right.
Am I going to have enough this week? And then we've had a really good year and a little bit to where you haven't had to do that. So I think that's nice.
But I think it's about financial visibility. And it's about, making decisions based on numbers, not on your gut instinct, not just looking at your at your bank's web portal and seeing how much money you have according to the bank, and like, oh, I must have some money. Yeah, that's not how that works.
Yeah.
And having some, visibility into your P&L statements and your statement of cash flows, which we never kept a statement of cash flows, which
Right.
even though, I took accounting in college and I understand the basics, you have a balance sheet, you have a P&L, and you have a statement of cash flows. And I would say that the vast majority of law firms out there of our size and below, they have the first two. They have the balance sheet, and they obviously probably keep a profit and loss statement. But very few firms out there keep a statement of cash flows, and that I think is critical, because you can have so much phantom income out there if you don't understand how cash moves and how cash accounting works. Most firms our size use cash accounting. We don't use accrual accounting. And if you don't know what those two things mean, you better have a good accountant that does.
Or somebody you better
have somebody that knows how to deal with this for you.
So what do you mean by phantom income?
So there's two types of things that really affect your cash flow that do not show up on a profit and loss statement. In most law firms out there, they have a profit and loss statement that they pull off of their QuickBooks. And most firms out there use QuickBooks. I as much as I hate QuickBooks, we have to acknowledge that it is the 800-pound gorilla of financial softwares out there. And most people use QuickBooks for their accounting software. And they will run a profit and loss statement every month, every quarter. And they'll see the number at the bottom, like, oh, well, I must have, let's say, call it $100,000. I got $100,000 in profit this month. Well, there's a problem with that. There's probably multiple problems. I can think of two that have affected us specifically. Number one, when you have a line of credit through a bank, and we do financing for certain things. We do financing for case costs. We do financing for marketing costs when we get into different mass torts. If we buy a big piece of equipment, we may do financing with that. When you repay that financing, your repayment comes in two pieces. One piece of it is the interest, which does show up on the P&L. And one piece of it is the principal. In other words, you're paying back principal on the loan. Well, guess what? The principal doesn't show up on the P&L. So if my profit and loss statement shows I made $100,000, last quarter, but I made let's say I made $20,000 worth of principal payments last quarter, I'm really only $80,000 to the good when my P&L says I had $100,000 in profit.
Right.
But I only had $80,000 in cash flow, and all of a sudden people can't figure out, why do I not have any cash? I had $100,000 in profit last quarter. I'm like, no, but you only had $80,000 in positive cash flow because you don't record the principal in your profit and loss statement. It's recorded in the statement of cash flows, which most people do not keep. The second thing that has affected us over the years that I realized, most contingency fee firms, we front expenses on our client cases. Let's say in a typical month, I front $20,000 in client expenses for medical records, for expert reports, for filing fees, for all of these miscellaneous things, and they add up. Let's say I'm spending $20,000 a month on that. Well, if you're doing your accounting properly, the IRS considers that a loan to your client, and it is not a deductible expense. You don't get to deduct that. It doesn't hit it. If you're doing it properly, it doesn't hit the P&L as an expense. So now I've gone from $100,000 in profit for the first quarter. Now I've subtracted $20,000 because I've paid back principal and interest, and now I'm subtracting another $20,000 because I put $20,000 in expenses into developing my cases. So now I only have a positive $60,000 worth of cash flow, even though my profit said I had $100,000 in net profit, of which you have to pay taxes on the full $100,000, not the $60,000. You pay taxes on the full $100,000. And I'm sure there are other little traps out there that I'm not thinking of, but these were the two big ones that really always affected our cash flow, and I was always befuddled by it. Like, why do we have so little in cash when our profits seemed fairly healthy. And it was because I wasn't taking into account those two accounting issues, and I wasn't properly working with a proper statement of cash flows. And I'm just using round numbers and trying to use it as examples, but until we kind of got a handle on that and kind of got our head wrapped around that and realized, hey, we're paying taxes on the full $100,000. So let's say your marginal tax rate is 25%. So now you're paying another $25,000 for the quarter in taxes. So now your cash flow, now your cash flow, and that's not an expense either. That doesn't come off the P&L. So now we've knocked off $55,000 in cash has been taken out of that $100,000 profit that we've had for the quarter. Now we're down to $45,000. So these are all things, that people don't think about frequently. And I hate to bash lawyers, but I'm gonna. A lot of lawyers out there went and got liberal arts degrees in their undergrad. They're poli-sci majors, they're communication majors, and so forth. And they probably didn't take a lot of accounting classes or any accounting classes in college where you would learn some of these basics. Mm-hmm. This is my personal opinion. I think every college should require everybody to get a business minor. Because it doesn't matter what your major is. Like my kid wants to be a major in psychology. She wants to be a psychologist. Okay, great. But you're going to run your business. I have another kid that wants to be a music major and wants to start a music school. Great. Well, you're still running a business. You need some basic accounting skills, some basic finance skills, some basic marketing skills to run any business, regardless of what you do. Soapbox. Okay, I'll get off my soapbox. Tell your kids to get at least at a minimum get a minor in business. So that's my soapbox.
Well, and it's laid the foundation because today we're going to talk about we're going to use the Atticus tool to talk about the profitability.
Right. So the rules matrix is what they call it. Rules, RULES, which each stands for something, and I can't remember what, but that's okay because Diana knows, and she's going to tell us.
And I have a cheat sheet for it.
She has a cheat sheet.
So we're going to talk about the rules before or after the break?
We'll talk about that after the break. I did want to talk real quickly about a common myth that sort of dovetails into cash flow, which is more cases equal more profit. Mm-hmm. Especially contingency fee lawyers. We're always thinking about how many cases did I sign up? How many cases did I sign up? And that can be a trap because it really only helps your cash flow if you sign up better, more high quality, more profitable cases, not the low end variety. And I think sometimes we get trapped in looking at numbers as opposed to looking at the quality of the cases that we're taking on board, because lawyers love numbers. Oh, you signed up 50 cases last month? Well, I signed up 100 cases last month. Well, the person signing up the 50 cases could be more profitable because if your 100 cases suck,
yeah,
or
if you aren't managing them well,
or if you're not managing them properly. Or if they're just sitting around collecting dust. Mm-hmm. Time on desk is a key cash flow driver
for contingency firms.
You've got to move the cases. You got to move the cases. Let alone all the stress they cause. But anyway, so we're going to go through the rules in Atticus speak. I guess we're kind of modeling the book Cash Flow and Profitability by Marc Powers and Shawn McNalis. Mm-hmm. A little bit about what we're talking about. I think a lot of this came from that book. Again, we always pimp it out for Atticus. So always dropping a dime on Atticus.
This one was really cool. Not that their other stuff isn't cool, but I like the way that they laid this out.
Yes, this one laid out pretty well. Because it kind of comes out in a matrix sort of spreadsheety thing, and you love your spreadsheets.
I do. It's very easy for someone to understand. Even though I did take some accounting classes in college, it's a good refresher.
What was your major in college?
Liberal arts.
See, I just busted on you, didn't I?
Well, I was a university scholar at Baylor, which is a lot. Anyway.
Is that a real school?
Absolutely.
Oh, it's not some junior college up in Waco?
Not like Texas A&M, no.
Oh, yeah. Okay, great. So anyway, now that I've busted on Diana and her undergrad major,
We're going to talk about cash flow and profitability.
And specifically, we're going to talk about the rules. So we'll be right back.
This podcast is sponsored by Marc Whitehead Associates, a national disability benefits law firm. Marc Whitehead runs a firm of over 60 dedicated people whose mission is to make a difference in the lives of our injured and disabled clients. Marc represents disabled claimants in Social Security disability, private disability insurance, and veterans disability claims in all 50 states. Marc Whitehead is double board certified in both Social Security disability law and personal injury trial law. Marc has litigated disability cases in over 40 states and counting and can help your clients too. Stop throwing your phone calls away. Call Marc Whitehead at 701-VIP-LEAD. That's 701-VIP-LEAD. Or visit our website at disabilitydenials.com. Referral fees are paid in all jurisdictions where it is permitted. Refer us your disability cases today and know that your clients will be in good hands.
All right, Diana, tell us about the rules.
So the rules is an acronym, and R stands for rates, U for utilization, L for leverage, E for expenses, and S is for speed. So can you explain the matrix, Marc? So rates, so you're basically talking about, like, for example, how you charge rates.
Right.
whether
So
that's-
rates can be rates, as in like your hourly rate or your flat fee rate, or you could interpret that as revenue per case, i.e., if you're in a contingency fee, you're looking at what the average value of your case is. So the R stands for either rate or revenue per case, however you want to look at it.
and your collections process, I think, as well.
Right.
And so U is for utilization. So basically your productivity of you and your team.
Yes. A lot of that is production standards and time on desk. How fast are you moving your cases through the pipeline? How efficient are you moving your cases through the pipeline?
And then L in this acronym is for leverage.
So the way it was originally taught to me was your ratio of timekeepers to partners. Now, since we are in a contingency field and we don't do timekeepers, I think what we're really talking about there is the number of relatively inexpensively paid employees relative to your extremely highly overpaid lawyers. So in our firm, we have a pretty high leverage. We have 7 lawyers and probably an additional 70 staff. So we have about a 10-to-1 ratio between staff and attorneys. And that is, I would say we are highly leveraged. We have a lot of people with, relatively few lawyers working, and that creates a lot of leverage on our part. As opposed to if you've had the opposite. I see this in criminal defense firms, or I see it in insurance defense firms. They'll have 20 lawyers and only 10 staff. Okay, well, that is the exact opposite of leverage. So you're having your lawyers do a lot of, quite frankly, low-level menial tasks that are not very profitable. So when we talk about leverage, we're basically talking about the efficiency of your labor dollars.
Yep, and I think we'll also talk about technology and the even now, obviously, using AI for that kind of leverage.
The more you can use technology, the less labor you have to pay for.
Exactly.
So
next in the acronym is the E for expenses.
Yes, I think we all know what expenses are.
Yep, getting your ROI out of your investments.
So one of the things about expenses is there are pretty well established norms in terms of what something should cost as a percentage of your revenue. So for example, your labor costs typically in a law firm in a service industry should be somewhere in the neighborhood of maybe 1/3 to 40% of your revenue. We've had a problem with this. Our labor costs have been quite high as a percentage of our revenue, and we've been looking at that really hard. But it is there are established norms that you can actually look up. Your advertising budget. In a contingency fee world, somewhere between 10 to 15% is a fairly, common norm that you would see as a percent of, in other words, you would spend 10% of your marketing or 10% of your revenue on your marketing budget, or 15 if you're wanting to be aggressive, or 20% if you're hyper aggressive. I would tell you that would make an estate planning lawyer absolutely faint, because in that industry, or that section of the law, 2 to 3 to 4% of revenue is pretty common in terms of marketing expenses. So it does depend on what your practice area is. But there are norms out there that you can look up and kind of compare your firm, compare yourself to the norms, and see if you're really out of line with what those norms are. Again, we go back to the labor side. We think our labor costs are kind of high relative to the norm. And at least we know what we're looking at, so now we're trying to figure out how to address it.
And S is for speed, which is, I kind of think about time on desk when I think about speed. What do you think about S and for what that stands for?
Well, I think that's really what it means, time on desk. And I said time on desk when we were talking about utilization, and I think I may have misspoke there. So sorry.
No, well, I think it's all. So I think the way that Atticus taught us the rules matrix is that these are all the levers, if you will, that you can toggle to increase your profitability and or your cash flow.
Absolutely.
Okay.
So these are all little levers to push.
And so we're going to talk today about how MWA kind of looks at these levers and how you've done looked at the rules matrix over time to kind of increase your profitability, because it is different. For the last 2 years, as you mentioned in our first segment, we were in growth mode, and because in growth sucks cash.
Yeah, absolutely.
It just does.
It just does. And
so
that's why our
tough.
labor costs have been out of whack, because we've been in growth mode.
Yeah. So let's go back then, now that we've established the rules matrix, RULES, and we're going to go back to the top, and we're going to talk about rates. And actually, we just had a meeting on our rates yesterday.
Yes. So we're in a fee-capped industry. So to some extent, it's the argument is it's hard to raise your rates or your average fee for case if you are fee capped. Well, actually, that is not true. So what we did is we began to focus on quality, and we began to focus on tightening up our criteria of cases that we would accept to raise our average fee per case. One of the things we stopped taking SSI cases unless they were local because of the cost and expense involved in a relatively low dollar case. We stopped taking cases in certain age brackets in order to increase the average fee per case, because we were just losing a high percentage of cases, that were in the people in their 20s, 30s, and 40s. It's really hard to win disability. So we were becoming much more selective in the cases that we were taking, even in a fee-capped area. And we were able to increase our average fee, even with the fee cap, by $1,000 a case over about a 2-year period, when we started becoming much more selective in the cases that we took. I thought it would affect our intake numbers more than it did. It really didn't. As we started raising the quality of our cases, our marketing, I think, compensated for that, and just, we kept a steady growth, even with tightening up our criteria. And then, oddly enough, we had a new administration came in, and our average fee got raised by the government, not once but twice. So that also raised our average fee. Now, that you could say that was just dumb luck. I don't think it was dumb luck. I think it was good, hard lobbying on the part of NOSCR, our national lobby organization, to get us a raise. And we all pay our dues, and we all send our complaint letters in and say, please get us a raise. So I think we had some effect on that. But that's what we did. So the basic rule of thumb here for anybody is become more selective in the cases you choose to accept.
Yes, absolutely. So your client matrix, I think, is one of the most important things that you can do, one of the most important levers for your rates. And we are a contingency firm, but we do have a few flat fee services. And because even at our size, I think we can still toggle those very quickly. So we had a quick meeting the other day with our leadership team and our intake manager and one of our key intake specialists, and realized we might have priced ourselves out of. And so we
raised our rates and realized that we may have raised our rates a little too high.
We weren't selling.
We weren't selling these services as well as we had in the past because we had raised our rates. So we readjusted. Of course, we didn't go back down to what we were originally, but we're experimenting. We picked a happy middle ground. And we basically had discussions with our intake team because they're the ones actually trying to sell these services and, getting their feedback. And like, well, what do you think about this number? Well, why don't we went to this number? What do you think? Yeah, I think I could sell that better.
And what are the clients telling you?
Yeah.
When they give you this price, it's
what are your competitors charging?
Exactly. Or what are they telling you is happening out there? And so you absolutely leverage. Don't forget to talk to your people and especially I think most of our listeners are probably our size. You can be nimble, and so be nimble with your pricing. And I think that it's, so I think also we were talking about, actually, I have no idea where I was going with that. I'm done.
I would say I have one other idea on how to raise the value of your case in a contingency fee practice. And Craig Goldenfarb, our friend in Florida, has done this quite well and preaches about this, is they do a better job on medical management. They get actively involved in their PI clients and in their medical treatment. And how they value it is, they look at what percentage of cases do they obtain the policy limits. And they're mostly an auto accident practice. So I think in Florida, the policy limits are $30,000, and most people are carrying $30,000 in limits. So what percentage of cases do they get at least the $30,000 maximum?
Mm-hmm.
And that's how they value it. And once they started doing more aggressive medical management of their clients, I think what he said, he's somewhere in the neighborhood of doubled the percentage of cases where they maxed out the policy limits. Now, you got to do that in an ethical manner. You're not trying to trump up damages, but making sure your client gets the doctor, making sure they get the best medical testing, make sure that it's interpreted correctly, make sure you're looking for those subtle things like traumatic brain injuries, which frequently don't show up without more extensive testing, and you have to kind of be aggressive with that. In our case, we're doing more active medical management. We're trying to get doctors more involved in our disability appeals, not necessarily increasing the value of any one case, but we're trying to increase our win percentage, which ultimately increases our average collected fee over time, kind of the same concept. But, how can you increase the average value of your case? And every lawyer has to look at that independently depending on what their practice looks like. And
I would say, don't forget that collections is a key part of this R part of the matrix, which is your rates. One of the things that we did on our insurance side is make a KPI for our attorneys and for the PI firms, they have bonus metrics around it to where you actually don't get paid until the money, not get paid until the money comes in, but some of them actually diminish the amount that you get paid if the receivable, for lack of a better word, goes out too long. But now for us, we just have a KPI where we try to get the money in the door by, call it 21 days.
Yeah.
So because they can linger, your attorneys think, okay, well, I've settled the case, but the money's not in yet. So you got to make sure that there's a process for receiving the money. And on the government side, check chasing, that is a huge part for of one of our positions, is to make sure that there's a reason why we're not getting our money. And so she's actively making sure that we're calling on our checks to make sure that they're coming in.
You gotta chase them down.
So we're moving on then to the U in our rules acronym.
All right, so you need to explain this one because I screwed it up the first time.
No.
I conflated this with speed, so I messed up. So start over.
Utilization, basically productivity, right? How efficient are you?
Using your dashboards, time tracking, even if you're a contingency fee firm, using production standards. How well are you utilizing your labor force?
Yep. So I absolutely think that, we've already done a lot of podcasts, so I won't, do that again. But time management, I think we revisit that with our team a lot. We just did that with our team leaders, is making sure at about halfway through the year, are you still really focused on the right things? Because especially in a growth oriented firm, I actually just talked with one of your team leaders today, just like 30 minutes ago, and she's like, it's just not stopping, Diana. It's not stopping. And so it's so easy to forget, okay, what are our three things? Because it just continues to, when you're growing, just what's happens.
Right. I would give one example of utilization, and really what utilization means about matching the task to the pay level of the person doing it. Mm-hmm. So attorneys should be doing things that only attorneys can do, and paralegals should be doing things that only paralegals can do, and your medical records specialists should be doing the things that they can do, and even down to your clerks or whoever, what your scale looks like. The best example I can give, now this is a little outdated example because technology has helped a little bit, but back in the day, when we first started using overseas labor, we started using workers in the Dominican. Mm-hmm. The first thing we used them for was to simply be on hold with the government, because we had to make those phone calls to the government to find out information about our cases, and we would have to be on hold for 30 or 45 minutes, and it was an insane waste of valuable production time by our paralegals.
And then the government would hang up on you.
And then the government would hang up on you. So we hired overseas people, and their sole job was to be on hold with the government. And as soon as the government answered, with it to get our person back on the line. That would be an example of a solution that we use to improve the utilization of our labor.
Yep. And so, what you're talking about is delegation. And obviously, we've talked about a couple of really important tools before in other podcasts, the EOS Delegate to Elevate tool, and then the Eisenhower Matrix. So we won't rehash those in this podcast, but please just make sure you're using those as you grow.
Make sure you go back and listen to all 40 of our prior episodes.
So moving on to L in our acronym for leverage.
So one of the key things about leverage that I look at as an aggregate number is my total labor cost divided into our total revenue for any particular practice area. So for example, if my total labor to run my Social Security division for the year, including everything, including their health insurance, their taxes, all of that fun, all the stuff you got to pay, is $1 million, then I use a 3-to-1 ratio, which is a pretty accepted standard. Then I need to see at least $3 million of revenue coming out of that division, or you could do it backwards. If I'm making $3 million a year at my Social Security, in my Social Security section, then my labor expenses shouldn't be more than $1 million. And if we haven't met that 3-to-1 ratio, in other words, that leverage point, then we need to look at that really closely and see what we're missing. Now, 3.5-to-1 is better. 4-to-1 is better. 5-to-1 is even better than that. But I have been to enough seminars and enough lectures and read enough stuff to know that 3-to-1 is sort of the standard, the minimum standard that you're looking for. You could also just run that with your whole firm. If your labor costs for your entire firm, including the owner, you got to include the owner at their fair market value salary. Not what they pull out in terms of profit or profit sharing, but what their salary worth would be. If your entire labor force, including yourself, costs you $1 million, you need to be making at least $3 million in revenue, or something is off. Something is off there. So that's I think the number one leverage ratio that you look at.
Yep, and unsurprisingly, because you and I have this push and pull all the time, especially when our attorneys come to us and ask for more labor.
They're always asking for more labor.
They're always asking. And I always look at our technology stack and just what are you efficiently using the technology that we've given you in order to make sure that you're not just doing the same thing that you've been doing for the last 2 years in the same way. So AI obviously, without a doubt, can help you if you're leveraging it correctly.
Yeah, and our Litify, our case management system. That's kind of how it was sold with us. Like, hey, you implement this technology, you can eliminate X number of employees. Because you don't have to keep hiring labor because the technology will take over some of those tasks. I'm not sure how that really worked out, but I haven't put pencil to paper on that one yet. But
yeah, I don't know about that one, but I will say that this newest technology that we're implementing now is called Foundation AI. So I can't attribute to it, but it actually just came across our PILMA listserv today as another law firm on the PILMA listserv highly recommended it because it consistently gets you, someone's consistently scanning your mail, whereas right now ours is kind of bifurcated amongst the departments and there's a lot of human touch points. So technology is changing every day, so make sure you stay on top of it. And then of course, the other part of that is training. So are you making sure that your people are efficient in the way that they're doing things? Not only are they using the technology, but are they doing things the way that you want them to, rather than, you always told me, where are the most clicks? Eliminate the most clicks, Diana.
Right.
And then so we'd move to E for expenses.
Good old expenses. We know what expenses are, but there are a lot of expenses that I think people just blindly pay every month. I know we've done it. We did an audit last year of our P&L and our recurring expenses, and we found, I don't know how many expenses that nobody knew what they were for.
We did.
We were just getting tagged on our credit card every month for this things, and nobody could tell what they were. And it took us months to figure out. And some of them were legit.
Yes.
We didn't get rid of all of them just because at least I needed to know what they were so I could make an informed decision. A lot of things we cut. I had a gym membership.
I didn't know if you would admit to that one.
Yeah,
Mark.
I know. And
When was the last time you went to that gym?
About 2 years ago.
It was a very nice.
We were getting charged for $80 a month for a Hulu account, and nobody for the life of it could figure out who owned that Hulu account. Just goofy stuff, and a lot of it was just so minor that nobody paid attention to it. We were spending an amazing amount of money every month on Amazon, and we're trying to get a hold on that. What's that all about? Turns out a lot of it was legit. It's office expenses that we were buying cheaper through Amazon, but nobody was accounting for it.
Well, I, again, unsurprisingly, disagree with a little bit on the Amazon. I think it's just because the Amazon becomes so visible. And so it tends to be the thing you focus on, right? Because Amazon will charge you almost by, depending on the seller and all the things, it's just the reoccurring line item on your credit card. But the way that we grouped things, and I got 0 credit when I did this in our finance level 10. None. Mark, I think, actually rated our meeting a little lower because... what did you call it? It was Diana's I told you so spreadsheet. Mm-hmm. Mark and I disagreed about where he was spending his money in Q1, and I showed it to him, and he was not happy. He was not I thought I would get kudos. I did not get kudos for my spreadsheet.
Damn you, woman.
That's okay, though. It's important, though, that you do have someone who's looking at that and is willing to say, okay, Mark, it's actually here, and are you okay with it? And that's what we did. Are you okay with where these are your big 5? So you run a simple Excel spreadsheet, download your expenses from QBO, put them into an Excel spreadsheet, run a pivot table, and then you can categorize
There's that word again, pivot table. I have no idea what a freaking pivot table is. You and your pivot tables.
That's the best one, though. So when you run that pivot table, you can very easily see by percentage. I mean, you can do it by, you can run many different ways. You were not thankful I did it, but that's okay. It was a very good reminder of where we were spending our money in Q1, and you ended up being okay with that.
Yes. So our goal was to cut $100,000 out of our budget.
When we did zero, what did you call it? Zero budgeting?
Zero-based budgeting.
Yeah.
Like every single line item needed to be rejustified. It couldn't exist just because it's always existed. You had to rejustify every single line item's existence. Did we actually cut $100,000 out of the budget?
I think we got close.
We got close to it.
Not together, not just in office overhead, but I think with marketing, and I think we cut $100,000 somewhere.
Yes.
I will say our Atticus, I don't think he's our Atticus coach, but last time we were at Atticus, our zero-based budgeting, I mean, he said maybe do that once a year. Don't do it like
He
quarter.
said no. He said once every 2 or 3 years.
Yeah, I said that. I thought he said every 2 to 3 years, but
He was once every 2.
I wasn't sure. Okay, and then our final letter in the acronym was S, which stands for speed. And now this is time on desk, right?
Yes, this is time on desk, and I think the concept here is that time kills value. Faster settlements equal higher effective rates. I like this one. I will say that this is one that I probably violated the most during the early part of my career when I was a car wreck lawyer, because I would sit there and like, well, I don't have to worry about settling these cases today because they're still going to be here. We'll get them settled. We'll get them settled next month. I'm going to work on something else. And I wasn't so concerned about making sure the cases got pushed fast enough. You know, like, oh, I got 6 months before the statute of limitations. I don't need to file the case yet. I can wait for a few months to get. And all of that was counterproductive. And quite frankly, it was bad client service.
Yes.
I will admit that during my early days, my client service was probably not as good as it should have been because I just, I would let procrastination sometimes rule. I would pay attention to the squeaky wheel and not pay so much attention to speed and cash flow.
Yep. And I was actually, when we were having our flat fee discussion the other day, I realized, it's important also for our flat fee listeners to think about time on desk, not just our contingency listeners, because one of the things that we heard when we were talking about, because we can essentially sell three flat fee services, and they obviously tier up depending on the service. And what we heard from our intake team was that there was a lot of overproduction in the lower tier, which was eroding our second service because we were just basically doing too much in that lower priced flat fee service. So time on desk can still be a real thing for flat fee.
Oh, absolutely.
Firms.
Well, and a lot of flat fee firms, they get like half down and they don't get the other half till the end of the project or whatever it is they're working on. Well, that other half is kind of important.
Yes.
You need to get it in the bank.
Don't forget about overproduction. Mm-hmm. So now that we've run through the matrix and how we've used it, what are we going to talk about in our next discussion, or our next segment, Mark?
So I think we're going to do a quick wrap up. Honestly, I forgot.
We're going to do
but it's going to be brilliant.
We're going to do a quick wrap up.
Oh, we're going to talk about mindset.
Exactly.
That's what we were going to talk about.
Yeah, we're going to do a quick wrap up and mindset.
I'm Marc Whitehead, a lawyer, entrepreneur, and business coach. Thanks so much for tuning into the Successful Barrister podcast.
We have a blast creating it,
and I hope you find it helpful. If our chats have sparked your interest, I'd love to hear from you. Shoot me an email at mark@markwhitehead.com. That's Mark spelled with a C. And join the Successful Barrister newsletter. Even better, let's hop on a call. I'd love to chat about how we can collaborate, share ideas, or just catch up.
And we're back. All right, so we're going to go with our wrap up from chaos to clarity, I think is how we titled this last section. So, Diana, how do we go from chaos to clarity?
Well, I think as with everything we talk about, you got to start with your mindset shift. You just got to think about your mindset going from basically, well, the way Atticus taught it to us was a concept from a book that I've read. I don't know if you've read it, Rich Dad, Poor Dad.
Oh, I read it.
Yep. And so going from thinking like an employee to basically an investor, but really a business owner.
Right. So the way they've defined it, that there's the cash flow quadrant, and this is, I thought, was the most brilliant part of the book. And he actually laid it out a little bit better in one of his subsequent books that I cannot remember off the top of my head. But in either or both of those books, the cash flow quadrant was in there. And he defined 4 terms. What's an employee? So an employee is somebody that trades time for money. Okay.
Yep.
And that's perfectly fine. And a lot of people do that. And a lot of people are quite happy doing that. And quite frankly, we as entrepreneurs, we need those people. We need the people who are willing to trade their time for money. Okay. That's great. That's what capitalism is. That's what makes the world go round. But the next step in the evolution is somebody who's self-employed. And I think this is the worst of all worlds because you own a job, you don't own a business. A self-employed person, and I'm talking about somebody that's small. I'm not talking about somebody that's moved up to a business owner level or the investor level. But if you're just a self-employed person, you own the job, but you have the world's worst boss because your boss is yourself.
Yeah.
I can't think of anybody worse to work for than myself.
Yeah.
From my perspective, anyway. So you're still trading your time for money, but you also own all the risk. You also own all the downside because you own the business, and you don't really have a whole lot of upside if you just stay at that level. For example, the guy who owns my lawn or mows my lawn, okay? When he first started out, he was a solo operator. He basically was self-employed. And, hey, if it rained, he couldn't mow lawns. He couldn't get paid. If he was sick, he couldn't mow lawns. He couldn't get paid. If there was a drought, you can't mow your lawn as often. Mm-hmm. There's so many things out there that affected his day-to-day ability to use his own labor, okay? But he was self-employed. As he grew, he added employees. He added services. He added landscaping. He added horticulture. He added, arborist services. And I'm sure he was educating himself somehow. I don't know how he did it. He created crews. He created teams. He stopped doing the day-to-day work, and he focused on selling and managing. And basically, he went from being a self-employed person to a business owner. So I kind of liken that to my journey. When I first started off, I was a solo.
So you were the self-employed quadrant.
I was just in the self-employed quadrant. I owned a job, not a business.
Because if you were sick or couldn't go to trial or was on vacation, you had no revenue.
I tell the story when my daughter was born and up in emergency situation up in Dallas, and we were stuck up in Dallas for 8 weeks. I was out of commission for 8 weeks. I was the revenue producer. That's the definition of somebody that's self-employed. You're the revenue producer. Nowadays it would be totally different. Now I'm a business owner. So when you're a business owner, what you're doing is you've built systems that leverage people. So we build teams. The teams are all self-sufficient. The teams all have redundancy built into the teams. You build systems. You build processes. You build procedures. You employ technology. You basically build a business that is self-sustaining despite whether the owner can put their time, effort, and labor into it on a full-time basis or not. And I think that's where I'm at. I think that's where most people that listen to this podcast either are or aspire to be.
Completely agree.
The next one, it took me a long time to figure this one out, but the next level up, according to Rich Dad Poor Dad, is the investor level, the investor model. And the investor makes money work for them. I think the way he described it is, don't be a banker, be the bank.
Right.
The best job in the world to be is the bank, because the bank just sits there and uses other people's money to make money. Right. They just make money off of money. It's a brilliant business model as long as they don't get stupid and make bad loans and all that kind of fun stuff. But I really liked the mindset. And I think most of us, what I teach when I coach my people and talk to people, especially young lawyers, everybody wants to go out and hang out their own shingle, okay? Well, that's great for a while, okay? But you don't want to stay there. You want to move up to the business owner. That's the mindset shift. And I've known lots of attorneys who never made that shift, that have been practicing law for 40 years and still are, they're just self-employed. They're still doing all the work. I mentioned this on a podcast once before, but I met this woman. She was 65 years old and had what she described as a relatively successful employment practice.
Oh, yep. You met her at Atticus.
And she was like, I kind of want to sell my practice. And I'm like, well, tell me about your practice. And she goes, well, I do employment law. Okay. How many employees do you have? None. Okay. Do you have any other lawyers that work for you? No. Do you have any contract people that work for you? No. So you're still licking the stamps. Okay. You're
answering the phone.
You're still answering the phone. You're still doing everything. Okay, so you don't have a practice to sell. You have nothing to sell. You are basically a self-employed person.
And she may have had a very profitable, like her P&L may have looked really nice.
Right.
She might have even been cash flowing.
She may be cash flowing quite nicely, but she's 65, and the first health event that she has, and we're all going to get it sooner or later, all of a sudden your revenue totally shuts down because you're a self-employed person, and you just got to move past that.
Well, and I think that the great thing that Atticus does is force attorneys in that position to think about succession, to move to that mindset shift of succession, of creating systems and processes, and things like the rules matrix to make sure that you are leaving an asset behind for your people, or creating an asset that will sustain your later life. I think that was one of the presentations from the summit last year. So
and I kind of think the reason we kind of went into this mindset shift, this rich dad, poor dad cash flow quadrant, is because the whole key to maintaining good cash flow, which is the topic of this podcast, is you got to keep the cash flowing. And if the cash depends upon you, you have a vulnerability there, because none of us are Superman. We are all subject to life's whims, whether it be a health event, whether it be a family event, whether it be, I just want to go take a 4-week vacation. Something out there eventually is going to come and disrupt your ability to generate revenue. And if you are the only one generating the revenue, you have, by definition, you have an unpredictable cash flow stream. And that's kind of the point I think we're trying to make here.
that's a great wrap-up point.
Yes.
Marc.
Well, I had a few other wrap-up points I wanted to get to.
Well, my one wrap-up point was that I think the rules matrix is a good one to look at again and again, depending on what phase of the growth that you're in. But also, like we just said, we just did it yesterday.
I think you should go through this at least once every year till the day you die. You should look at these at least once a year and figure out how we could do each one of these elements better. The main one, run your practice like a business. Have dashboards, have financial targets, have accountability, get a good accountant, okay? You got to have a good accountant that helps you with this thing. Don't get an accountant that keeps the score. Get an accountant that helps you affect the score, okay?
Two very different accountants.
Two very different types of accountants, okay? Craig Foster, my accountant for about 17 years before he passed away, was very, very good at that and totally changed my financial trajectory. He coached me through so many financial issues, set me up in the right business organization structure. We talked about taxes, we talked about investments, we talked about all of this stuff. And he really helped affect the score. Whereas my prior accountant just kept the score. He goes, here's what you owe within the year. That's all he would say. Here's what you owe.
Yeah.
And I'm like,
here's what I need to file your taxes.
Okay, well, all right. Well, what did you do? So anyway, with that, I think we're getting the high sign that we're about ready to get out of here. I know it's the end of the day. You want to go. I got other stuff to do, but.
As do I, sir.
All right. With that, we are out of here. I want to thank all of the listeners for listening to the Successful Barrister podcast, where legal legends are made. I'm Marc.
And I'm Diana.
And together we're the dynamic duo of law. So remember to rate and review us wherever you get your podcasts. And if you've just enjoyed this episode, tell your friends, tell your family. Go rate us. 5-star reviews. We really need those, especially you people out there who've been asking for my goodies. And I've been sending them. So go give us a 5-star review. Visit us at successfulbarrister.com, and be sure to visit our sponsor, Marc Whitehead Associates, a national disability law firm, at disabilitydenials.com. And with that, we are out of here.
Bye.